here's an alternative to the strategy, and it's one of many. Set up the same scenario. Take the 30-year mortgage, make the payments to the bank for the first 15 years, make the side investment for 15 years. The account's still going to grow to about $200,000. However, for the second 15 years, if you can, instead of pulling the money from the side account, pay the second 15-year mortgage payments out of pocket. So you're acting as if you had a 30-year mortgage out of pocket anyway. The side account will now be growing at roughly 10% on average, not 2%, because you're not pulling the money out. Now, you will have paid an additional roughly $193,000 over those 15 years in the form of your payments. However, at the end of the 30 years, that side account will be worth approximately $840,000. And all we did was let it compound for 15 years. Now, what that amounts to is about $640,000 more than the extra payments that you paid for the second 15 years. It amounts to about $565,000 more than the value of the side account if you'd let it take over the payments. But here's the part that people really kind of fall out of their chair with. It's worth $730,000 more than the interest that people didn't want to pay because of the 30-year mortgage. This is why I say the interest isn't that important. By being willing to pay the interest and the extra payments, you created close to $750,000 in liquid assets outside of the house. So in raw terms, yes, there's a savings in interest by taking the 15-year. However, given a relatively small amount of money, $482, it's less than $500 a month for 15 years, that amounts to $86,000 extra that you paid in the first 15 years. You can grow close to $750,000. This is why I say cash flow management is the cornerstone. How we manage cash flow sets up everything else. This is just one example. Other examples might include credit card payoff strategies, IRAs, 401ks, and so on. Now, another point is for those of us that are socially responsible investors, if you're making the payment to the side account, and the side account's invested in socially responsible investments, now you're channeling that money and creating a tenfold increase in what you invested in areas that are doing the kinds of things you want to do in the world, as opposed to sending all the money to the bank, which may or may not be a socially responsible bank.